Hello, I'm Danny Liberatore, financial advisor with Raymond James, and today I'll be going over the differences between stocks and bonds, which are the two main classes of assets investors use in their portfolios. Stocks offer an ownership stake in a company, while bonds are akin to loans made to a company like a corporate bond, for example, or other organizations such as the U.S. Treasury. In general, stocks are considered riskier and more volatile than bonds. However, there are many different types of both options that offer varying levels of volatility, risk, and return. Let's compare. When an investor buys a stock, he or she is buying part ownership in a corporation. The value of a corporation's stock is usually tied to the earnings experience of the firm, up when it's doing well and down during periods of loss. Generally speaking, the higher the potential return, the higher the risk. Stock investors normally expect a higher rate of return because there is no schedule for repayment and no stated rate of return like that paid by fixed income securities such as bonds. Bonds are simply loans made by investors to an organization, be it a company, a government, or some other enterprise. A bondholder essentially holds an IOU. Unlike with stocks, bondholders do not share in the organization's profits. Instead, they get a fixed rate of return on their investments. Bonds are issued for specific time periods. When a bond expires and the original investment or principal is returned, the bond is said to have matured. Some bonds can take as long as 30 years to mature. One important distinction between stocks and bonds is that stocks have an unlimited ability for appreciation. Bond buyers, on the other hand, generally know the upper limit to expect on their investments, especially if held to maturity. If you have a lot of time before retirement, stocks have some substantial advantages because there is more time for the market to correct any downturns that hurt the stock's value. However, that doesn't mean bonds should be ignored. Quite the contrary. Bonds are useful tools for their ability to hedge against market fluctuations and the ups and downs of the economy. That's why a mix of stable fixed income investments and stocks is a key ingredient to achieving your long-term financial goals. For more information on bonds, stocks, or any of your other financial needs, feel free to contact me at danny.liberatore@raymondjames.ca or call 905-482-8393. See you next time.